Welcome back to Cheddar Business. Airbnb's losses reportedly doubled in the first quarter. This comes ahead of the possibility of Airbnb going public next year amidst investor skepticism surrounding some tech companies and rocky IPOs. Joining us now is David Snider, founder and CEO of Harness Wealth. David, this is interesting because, yes, we hear about Airbnb's losses doubling, but at the same time, this is a company that reported earlier this year it's EBITDA positive, earnings before, or earnings, a measure of earnings, I should say.
Sure.
So it's not like WeWork, for example. It's not like Tesla. It's not like a lot of the companies that are public now or have gone public recently.
Exactly, yeah. I mean, Airbnb is doing what a private company should, which is not looking at the quarter-to-quarter performance. This was not a company release of financial information. It was reporting through the information that was then covered in the Wall Street Journal. And so there are no liquidity issues at Airbnb. They've got multiple years of runway in cash. They've been profitable historically. From everything that's been reported, it seems like this is a major investment in marketing. They've got significant product and development. So I think it's in its own category, and people are sort of lumping together a trend line that may not exist.
The investment in marketing, though, I think is a red flag to some investors these days. We've seen massive layoffs at Uber in the marketing department, some of these other high-flying tech companies in the private market, tapping the public market to not a ton of fanfare, despite those very lofty valuations in the private market. If Airbnb is going to spend heavily on marketing, how does it need to pitch that story to investors to show that that is a good investment?
Yeah, I think it's really two things. One is it's got a different gross profit margin profile and different unit economics. So if they can tell the story that a dollar spent on marketing is returning $1.50 or $2, $3 in the future, that's a compelling story. That's what most companies are doing that you want to see. I think the other element is really around sort of whether the marketing and inventory they collect then becomes exclusive. I mean, one of the criticisms of Uber is that they're spending lots of dollars and those same cars are also on Lyft or other similar platforms. And so if Airbnb can spend in ways that locks up inventory, that's also very accretive to long-term value.
Do you think it's even fair to put this in the same bucket as recent IPOs that haven't done well? I mean, Peloton, Smile Direct Club, Uber, Lyft, the list goes on. Or is this a completely different animal?
Well, there are some that have done really nicely, Zoom, Datadog, others, and so I think the market has had enough that they're able to sort of pick and choose and look at each individually. I think it is a different business than Uber, certainly very different than WeWork in terms of the cash position, the gross profitability, the competitive advantages of the business. So it's not surprising as well that it's trading at a 20+% premium to its last valuation, at least on some of the secondary market platforms that I've checked.
David Snider, founder and CEO of Harness Wealth. It's always great to see you. We are unfortunately going to have to leave it there. Thanks so much for joining us this morning.
Thank you.